Welcome to Talk Tickers, the deep dive, where we really get into the details of corporate earnings calls.
And today we're looking at Simmons First National Corporation, SFNC, their Q3 2025 results.
Yeah, and this wasn't just another quarter, was it? Management basically telegraphed this as the big one.
Oh, absolutely. They used the word transformational. This was supposed to be the quarter they finally, ripped the Band-Aid off and reset the whole balance sheet structure.
So our job today is figuring out, okay, what did that transformation cost? And maybe more importantly, what's the potential upside now? We're talking net interest income, margin defense.
The works. Exactly. What does this mean going forward?
Okay, let's start with the headline numbers because they were pretty wild, just jarring, really.
Yeah, you had two very different stories depending on where you looked.
Right. First off, the GAAP earnings per share, a massive loss. We're talking negative $4 per share. $4.
Which, understandably caused some initial waves. That's a big number to see in red.
But then you peel back the onion a bit.
And you get the adjusted EPS. That came in at 0.46 cents. Now, that did miss the consensus estimate, which was $0.48.
Only by 2 cents, though. And frankly, the consensus seems to have completely missed just how much pain management was willing to take here.
Definitely. That huge JAP loss was the cost of the fix. Strip that out, and the underlying picture looks very different. And the operating metrics were actually showing strength even amidst the chaos.
Yeah, adjusted revenue looks good, somewhere between 232.0 and $232.5 million. That's up, 33% year over year?
A really solid number. And net interest income, the NII, that was strong too. $186.7 million, up 9% just from Q2.
Which is pretty crucial, right? It shows the core engine was still running well even while they were doing this major surgery on the balance sheet.
It does. And I think the market reaction reflected that. Initial shock at the GAAP loss, but then the conversation quickly pivoted to, okay, what do the fundamentals look like after this reset? And investors seem cautiously optimistic, willing to accept the short-term hit.
Okay, so let's get into that surgery. The financial engineering. You called it ripping the Band-Aid off. What exactly did they do? It sounds pretty complex.
It was aggressive, no doubt. Think of it as a major cleanup. The headline item was that massive $801.5 million pre-tax loss.
Okay, where did that come from?
That came from selling off about $2.4 billion worth of older, low-yielding securities. These were assets stuck on their books, maybe yielding, 2.5%, 3%.
While their funding costs had shot up way past that.
Exactly. They were essentially losing money on those holdings. Dead weight. So they took a calculated, albeit enormous, hit to get rid of them. Structural challenge removed.
Right, but selling $2.4 billion in assets leaves a pretty big hole.
Yeah.
How did they fund that sale and, reposition things so quickly?
That's the other side of the coin. It wasn't just a sale in isolation. It was coordinated with a capital raise they did back in the summer.
The equity raise, right.
Yep. They raised $327 million in new equity back in July, priced at $18.50 a share.
Okay, so they got cash from the equity raise and from selling those securities.
Yep.
And then they used that cash to
attack the liability side. They immediately paid down expensive temporary funding sources. We're talking wholesale funds, public funds, and particularly those costly Federal Home Loan Bank or FHLB advances.
Stuff they were relying on, but that had a really high beta moving quickly with rates.
Precisely. So they swapped out that expensive temporary debt for permanent equity and the cash from the asset sales. Boom. Lower funding costs almost overnight.
And that shifted them from being liability sensitive, which hurt them when rates rose, to being asset sensitive.
That was the goal. And the results showed up immediately in the net interest margin, the N.
Okay, let's talk NM, the fully taxable equivalent NM, NNFTE. For the quarter, landed at 3.52%.
Which is a huge jump from the 2.74% they posted in Q3 of last year. Massive improvement.
But the really telling number wasn't even the quarterly average, was it?
No, and this is key looking forward. Because they did the big repositioning during the quarter, the exit rate for September tells the real story.
And that was?
3.76%. That's the NIM they ended the quarter with.
Wow. Okay, so that 3.76% is basically proof this strategy, despite the GAAP cost, worked. That's the new baseline.
That's the launching pad, exactly. It shows the immediate impact of the fix.
So the big structural changes are done, the cost is booked. Where does management focus now? What's the pivot?
The message was clear. Pivot from defense, fixing the structure, to offense. That means driving efficiency in the business and looking for organic growth opportunities.
And I mentioned something about talent.
Yeah, they see the current maybe slightly disruptive banking environment as a chance to pick up strong talent. Strategic talent acquisition was explicitly mentioned as a focus alongside operational excellence. They think they're sort of in the middle innings on efficiency gains.
Okay, and what about guidance? That exit rate of 3.76% must give them some confidence?
It certainly seems to. They guided for the fourth quarter NIM to be 3.65% plus ARM. That little plus sign is important. They're setting a floor.
So 3.65% or better. How do they plan to defend that, especially if, the Fed potentially starts cutting rates down the line?
Well, first, the structure helps. Being asset sensitive now means rate cuts are less of a headwind, potentially even a slight tailwind compared to before. Their assets should reprice higher or faster than their deposits in that scenario.
The opposite of their old problem.
Exactly. And they've also significantly expanded their hedging program to provide extra protection against rate volatility. Their goal now is to defend a NIM range, roughly 3.50% to 3.75%, across different rate environments, including cuts.
Okay, but here's something that really jumped out at me from the call.
Yeah.
Management basically said they don't need huge loan growth right now to actually grow net interest income. How does that work?
Yes. This is probably the most powerful sort of hidden engine they have right now. It's the loan repricing dynamic.
Explain that.
They have about $3 billion, that's a billion, with a B, of older fixed rate loans on their books that are scheduled to mature and reprice over the next couple of years, say 24 months.
And these loans have really low yields currently.
Super low by today's standards, around 3.9% on average for that $3 billion portfolio.
Okay, 3.9%. But what are they getting on new loans they're putting on the books now?
Their ready-to-close pipeline, which is about $490 million, has a weighted average rate of 7.19%.
Wow. So you have $3 billion yielding under 4% rolling off, potentially being replaced by new volume yielding over 7%.
Exactly. Every time one of those old loans reprices, whether it's renewed or replaced, there's a potential lift of over 300 basis points baked right in. That flows directly to NII.
Set across $3 billion over the next 2 years. Yeah, you can see why they don't need heroic loan growth numbers. That's a massive built-in tailwind.
It's almost like contractual NII growth waiting to happen. It gives them runway through 2026 and allows them to be disciplined on pricing for new business.
And speaking of new business, they do still have pipelines, right?
Yeah.
Despite being disciplined.
Oh, yeah. The commercial loan pipeline was reported at $1.6 billion, and that ready-to-close book was nearly $500 million at that strong 7.19% rate. They did mention seeing some, let's say, irrational pricing from competitors, but they're sticking to their guns on quality and yield.
Makes sense. Now, to support all this, the margin defense, the future growth, what's the plan on the funding side? Deposits.
Huge focus there. It's all about improving the mix and relying more on core funding. They want to push out the expensive stuff.
Like those broker deposits you mentioned.
Exactly. The cost of deposits overall is already coming down post-reset, but their long-term, very ambitious goal is to drive brokered deposits down to zero.
Zero. That seems aggressive. Brokered CDs and similar funds are pretty common tools.
It's aggressive, definitely a long-term vision, but it signals their commitment to getting rid of what they see as hot money, those 100% beta funds that react instantly to rate changes and cost a lot. They want sticky core relationships.
How's that going? Are they seeing core deposit growth?
They reported positive growth in the number of consumer accounts, which is good. But they also noted that the average balance in those accounts is feeling some pressure, likely due to, ongoing consumer spending. So mixed signals there, but the strategic direction is clear.
Got it. And quickly, credit quality. Any red flags?
Not really. Management called it benign and inline. The key metrics look stable. Allowance for credit losses to loans is 1.50%. Non-performing assets to total assets is 0.66%.
Pretty standard stuff.
Yeah, and remember, they also mentioned proactively exiting some loans they deemed lower quality this quarter. So like the security sale, that probably held back the reported loan growth figure a bit, but it's part of that cleanup strategy for a stronger future.
Okay, so summarizing the path forward for investors. It's all about execution now, right? Hit that 3.65% plus Q4 NIM target, keep improving the deposit mix away from brokered funds, and let that $3 billion loan repricing engine really kick in over the next 2 years.
That's the checklist. The market seems to have understood the story during the call because the stock stabilized after that initial GAAP shock. Management did a decent job explaining that the big loss was basically them buying future earnings power by taking the hit now.
Okay, so let's pivot to our not financial advice segment. We're just brainstorming ideas here based on the call. This isn't a recommendation for anyone.
Absolutely not financial advice, just kicking around ideas.
Given this setup, the huge upfront cost taken, the seemingly solid floor provided by the 3.65% plus NM guidance, and especially that $3 billion repricing tailwind providing contractual NII growth, it feels like a lot of the downside risk has maybe been priced in already.
You could argue that, yeah. The structural changes they made provide a pretty significant defense against further margin compression, at least based on their guidance and the repricing math. The fear from the headline loss might still be lingering, creating some volatility.
So if you believe management can execute and that structural floor holds, how could you potentially play that?
Well, one slightly outrageous but plausible idea, given the setup, could be to monetize that lingering fear and volatility.
Okay, how?
You could consider selling put options, maybe mid-dated, like 6 months out and out of the money.
Selling puts. So you're betting the stock won't fall below a certain price by that expiration date.
Exactly. You collect the option premium up front. If SFNC management delivers on that in-name defense, if that repricing engine starts contributing as expected, the stock price should theoretically remain stable or even drift higher.
Letting the put option expire worthless, and you keep the premium you collected.
Right. It's essentially a bet that the floor they've built is real, and the market has maybe overreacted to the short-term pain. You're getting paid to express confidence in their execution and the structural defenses. Again, not advice, just an idea based on the dynamics discussed.
A bold idea for a bold quarter. Okay, let's wrap this deep dive up. Simmons First National, SFNC, took a huge swing. Massive GAAP loss, yes, but it was the price for shifting to an asset-sensitive profile with a defended higher margin.
The entire focus shifts now. Can they execute? Can they translate that new structure into consistent high-quality earnings? That's the question for the next year or two.
And management set a very high bar for themselves, didn't they? With the outgoing CEO's final comment.
Yes. Quite the parting shot. He basically said he expects headlines a year from now to read something like, Simmons Bank earnings up $650 million from the previous year.
Wow. $650 million year-over-year swing. That shows you the kind of earnings power unlock they believe they've achieved by eating glass this quarter.
That's the target they put out there. It reflects the potential payoff from this big, painful reset.
Definitely a story worth watching unfold. Thanks for joining us for this deep dive into Simmons First National Corporation. Go forth and analyze.
We'll catch you on the next one.